You're watching Stock Watch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today are Alex Duys from Umthombo Wealth and Cobus Potgieter from Southern Cross Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thanks so much for your time, gents. Let's start off with a very simple question. Okay, I actually don't know how simple it is. But the viewer says, I have about 1,000 Rand. Should I put it into the Satrix S&P 500 ETF? Well, why I'm saying maybe it's a simple question is because we've seen the pressure that the S&P 500 has been under. And so I imagine that the viewer thinks that this dip is a good buying opportunity. Cobus, your take?
Yes, always buy the dip. Especially in the S&P 500, where you've got exposure to the Magnificent Seven and all the rest. But look, in all seriousness, it's been a fantastic basket to hold. I mean, both from historically from a share, an equity performance perspective, as well as, of course, the hedge against rand devaluation, which for a South African has added significant benefit relative to being invested locally. If you want to take I wouldn't recommend taking a punt. There's a lot of uncertainty in this market. If you're sort of trying to look at it from a trading perspective, I would sit on my hands a little bit longer. But if you intend to be invested for the long term, and I always say it's better to be invested than not be invested. So absolutely, that's a nice enough stop pick for you right there. Just buy Satrix S&P.
On your side, Alex, I mean, some could argue that there's a reason why the S&P 500 has been under this much pressure. Would you be seeing as a good buying point, or maybe just alarm bells should be ringing?
Look, in this particular case, the viewer is looking to only invest 1,000 Rand, so I'd assume that over time he's looking to invest more. So that makes sense to buy now, and then just allocate money as you gain more over time. So don't overthink it. There might be better opportunities, there might not be. But the best is to start immediately and to have time in the market. I mean, if you take a 20-30 year view, the price you pay today is not really that important.
All right. I want to check in on the alcohol tariffs that Trump is threatening on European alcohol companies. We saw shares of Pernod Ricard, all these Diageo, all these alcohol companies in the US feeling the pressure. I actually thought that I would see some sort of action on AB and Bev, and more positive action, but I actually didn't. And then also I was wondering about Heineken, which Remgro has exposure to. Just your take, Cobus, on this threat and if it could affect the JSE in any way, whether positively or negatively.
I don't have my crystal ball out today, but the reality is with this tariff trade war, which is certainly escalating. Anything is possible in time. For the moment, these are reasonably targeted tariffs. So the utterances, let's just call them that, the utterances of a mad old man in power, are specifically in retaliation to the EU announcing tariffs on so-called American whiskey imports, bourbon imports. So this is essentially, amongst the things he mentioned, that these tariffs will be amazing for the American wine and champagne producers, which demonstrates a fundamental misunderstanding of what he's dealing with, because only champagne can only be made in Champagne. Not Champagne, Massachusetts, Champagne, France. So some of this is grandstanding, some of this is the art of the deal, right? Sort of threatening to do something incredibly severe and settling somewhere in the middle. But ultimately, this is to be expected. I believe, trying to win a trade war is difficult because you anticipate that you've got the stronger hand, and in time you'll be able to bully the other players into to sort of conceding to your requirements. But it's going to be, those guys know that you will keep pushing. The EU knows, China knows. You will keep pushing if you do win these concessions. So at some stage they got to dig in their heels and retaliate, and that's precisely what they're trying to do. And ultimately, I don't think it de-escalates until the US de-escalates it. In the short term, at least, beer seems to be unaffected, so we haven't seen any reaction from AB InBev or Heineken.
Well, thank goodness we have our own wine here in South Africa, and we may not have champagne, but we have MCC. Alex, are there any sectors that you are particularly worried about in terms of the impact and domino effect of tariffs on the JSE?
Look, I mean, you have to think about tariffs in relative terms, not only in absolute terms, right? So, because it's affecting pretty much almost every country at a particular stage. So it's about how competitive you are and the price points and so forth. So, for example, we saw Hulaman came out of an update, I think it was last week, saying of the impact of tariffs on aluminium is not really going to have much impact on them.
Yeah.
Because it's also impacting their competitors. So I think you have to look at it from that perspective. Also, when it comes to Trump, in my view, there's obviously, I think, two sides to the equation. One is, does he really want to achieve that, the first point? Or secondly, is it part of his method to try to achieve something?
Okay.
So, I think in this particular case, it's clearly that he's using it as a bargaining tool. And remember, the US does have the chips, right? So, I mean, they are enormous economy compared to the rest of the world. I mean, something like California will be the 5th largest country in the world, the country itself. Texas is bigger than Russia, and South Africa is like 10% of California, right? So that gives you the context of how big the United States is. They do have leverage, and they're going to try to use it. Can they use it? Time will tell. But I think it's important that people remember how big the US is relative to other countries. They do have excessive amount of leverage to play, and Trump is playing his cards. He might overplay it, but let's see what happens.
All right. Well, gents, let's get into banking. There's a question on Nedbank. Would appreciate insight on why Nedbank has been hammered despite them having published good results. Increased their dividend, their PE being low, their prospects looking good. Every other bank has seen an improvement in their share post the publication of their results, but Nedbank, after rallying to between 295 and 300, has dropped to a low of just above 262. On the day, I think the share did rally, if I am not mistaken. I think, no, or not, can't remember. But since I think the 6th of March, that share has just been on a downward trend. And Cobus is quite interesting because we saw Standard Bank's share popping more than 5% today. So why is Nedbank just feeling all this pressure?
I'm actually uncertain. I agree with you that the results were at or near expectations, and a decent set of results. Credit loss ratio didn't improve as much as with some of its competitors relative to the previous print, I suppose. And they might have been, just observing the movement today, it looked like there was quite a bit of switching out of Nedbank into Standard Bank. So people were particularly impressed with the Standard Bank numbers. But honestly, at current valuations, I think Nedbank is quite attractive. So I'm also a little bit confounded. And you, as you rightly pointed out, didn't rally off the back of those results, but there was market pressure across the financials, and it was a relative outperformer. But that has completely reversed, and it is now a significant underperformer. That relative movement between Nedbank and Standard Bank is in excess of 10% in a few days, I believe.
Yeah.
So that's for two of the most correlated stock on the exchange. That's quite remarkable.
Yeah, it's quite interesting. No one can really put a finger on it. I think when did I do Stockwatch on Tuesday? Even JP Verster and Mark du Toit said they're not going to lie to us and tell us what has driven that share price down, because nobody knows. Alex, is there anything you've heard through the grapevine or anything that you can give us at this point with Nedbank?
No, I concur with Cobus there, but I have to highlight that pretty much since late last year, SA Inc. has been under pressure, because even the retailers, for example, as well, and a bunch of other SA Inc. stocks. So share prices have been weak, and that's due to a function of perhaps some of the fusion for SA GNU is reduced a little bit. At the same time, we've seen a risk-off environment now in global as well. So, but I think the bank results were good in general.
Yeah.
I mean, Absa's results, Nedbank first round result, I think all of them are solid. I think it's actually a good entry point into the banks. I think the valuations are very compelling, and it's high probability that they're going to grow earnings, call it high single digits.
Yeah.
And they can do that, then the banks is offering you easily and maybe 15 to 20% total return. So I think it's a good buying opportunity. Don't think too much about what has happened, rather look forward.
And it's quite interesting that we saw this much buying activity on Standard Bank, because usually when I ask analysts on where they see the most value, it's usually a Nedbank or Absa. Cobus, just getting into Standard Bank at this entry point, what do you make of that?
Well, I was switching my Standard Bank for Nedbank today. Just given this absolutely extreme move.
Yeah.
I must say this is very, very severe. So I still like Standard Bank, absolutely. The thesis holds. Good
Yeah.
set of results, slightly ahead of expectations. But again, the credit loss ratio improving beyond expectations, and quite a bit of it coming out better than previous guidance. So, you know, I mean, to be honest, the thesis for all of the banks has held quite nicely. Yes, they sort of really past being cheap in Q3 of last year, but they've come off significantly since then. And now, off the back of these good results, Standard Bank, FirstRand, and Absa have recovered significantly, but not so Nedbank. Nedbank seems to be a laggard despite having similarly good results. So on that basis, you know, I think this is probably, if you miss the boat, that Nedbank's probably a decent entry point into this play. FirstRand still has that overhang over it from the uncertainty, the legal uncertainty in the UK. Which means I'm pretty agnostic at the moment, even though they believe the probability of a negative outcome is low. That's in the price, but Nedbank I like at this level.
Right, more questions. Is Old Mutual a buy at current levels? If I remember correctly, Old Mutual isn't out with its numbers yet. Santam and Sanlam have been out. Is there anything that you're looking at when it comes to Old Mutual, Alex?
Yeah, Old Mutual is a difficult one for me. The valuation, you can make the argument is looking cheap, but I do think from a earnings quality perspective, specifically since they've made the changes in the insurance side of IFRS 17, I think there's some question marks on Old Mutual, especially if you compare it to a Sanlam, where I think high quality of earnings, very conservative accounting, as well as actuarial assumptions. So for me, I've got a main clear preference for Sanlam. And Old Mutual, for me, it's more of a lukewarm. I'm struggling to see growth. You're going to see change in management there now in a moment, but yeah, it's not a business. I mean, even look at the asset management side of the business, not really great. I mean, the way they value it from IFRS perspective, questionable as well, but it's not really one that makes me excited. I think you could do much better buying Sanlam. I think it's got much better growth prospects in South Africa, as well as in India and Africa. I just think it makes more sense. And you're buying at an attractive valuation as well. Good dividend backed by actual cash, not using debt to pay dividends. And you could argue should trade at quite a sizable premium to its embedded value as well. So for me, there's a clear preference. Buy Sanlam and forget about the rest when it comes to long-term insurance.
Not exciting, but sometimes not exciting is good. Your take, Cobus, particularly at these levels?
We're also not particularly fond of it, but it is lagging its peers quite severely. We had call it a tapered trading update 2 weeks ago, and results coming out next week. So, I mean, there's certainly some risk being taken off at this level, but it is looking very cheap relative to its peers, even the less exciting peers like Momentum. So perhaps worth a flatter, but again, low, not the greatest quality and not the most amazing trading update either. So from that perspective, it's a little boring. Not when I'm that's even on my radar.
Yeah, all right. Well, what about City Lodge? How come City Lodge is so low? I paid R4.25 a share. Should I hold it? So coming from a rather frustrated investor there. Alex, City Lodge?
Yeah, when I started in the market in 2008, call it the first 10 or so years, I like City Lodge. But I've been disillusioned with the business over a lot number of years now. And I think they actually, the performance has been quite poor. Yes, there is upside potential if they can fill up occupancies and so forth. There's no doubt about it. They've been trying to diversify revenue stream more into the food beverage side of the equation, but they're struggling. The last update was quite poor. You know, some of the capital allocation decisions in the past not been great. They've reversed some of that. That BE deal was disastrous in the way they handled that as well. I think that's burned a lot of investors. Within that space, my preference is still for Southern Sun.
Okay.
I think that business is very well positioned. They're going to pretty much be in a net cash position soon. And I think the pricing power in these businesses are misunderstood, specifically in the Western Cape. Because there you can charge in dollars, so meaning you can pretty much in the rand terms, put your prices up 10-20%, yet your cost base remains in rand. So it really just gives you peak operating leverage, especially when you hit 65% plus occupancies. And we know Cape Town, for example, in February, it's like 90%. So I think that part of the portfolio for me makes much more sense than City Lodge, which does have a lot more business travel and more diversified over the country. Lower doesn't necessarily have the high LSM clientele that the Southern Sun has. So
Okay.
yeah, I've got not a bad business, but I do have a preference for Southern Sun.
Yeah, it's quite interesting because I mean, you look at the, I guess, improving business sentiment and consumer sentiment in South Africa, and you think that these hospitality stocks will all be lifted by a better environment. But yeah, there seems to be just this cloud on City Lodge, or this overhang on City Lodge. Cobus, your take on City Lodge?
Just in case your investor doesn't realize, they did just get a dividend. Went X on yesterday, in fact. So that's 6 cents that they can add back from the current level. Not an amazing set of results. I have to add, this is one of those businesses that lagged in maintenance during the COVID era. And there's been sort of a runoff and disruption as they have had to renovate the hotels, spruce them up a bit, and that's almost forced them to run a high vacancy rate during a period when one would have hoped that there would be some recovery in business travel. I still like it as the valuation is generous, frankly, at this level. So. I still like it. I think there's significant upside if business travel does pick up. And as the disruption caused by these renovations sort of runs out of results, and they can run at a somewhat higher occupancy rate. And given that the occupancy rate is so low, they have significant gearing towards any kind of recovery in business travel. So from that perspective, it's quite a nice play. I also prefer Southern Sun, and I like Soho as well, but those are certainly, showing the recovery better in their current valuations, whereas this one I think has more legs potentially.
All right. Well, let's get into Chinese tech, Alibaba. Can you please give me a view on the above share? What do you think this share will be in the next year or so? Cobus did say that he didn't bring his crystal ball with him today. Alex, do you have one for Alibaba?
Not specifically on Alibaba, no, but I do think China tech stocks for me still looks very, very attractive. I think, there's obviously a lot of investors globally that believe China is uninvestable, but I think that the tech space doesn't really form part of that. If you look at the relative performance to the Magnificent Seven or just Nasdaq over the last few years has been a big underperformance. And we know that China is not that far behind, if at all behind, when it comes to AI as well. And they've got some world-class businesses in there, which includes Alibaba, Tencent, etc. So I think China tech in general, I think is a good buy opportunity.
Okay.
It's a contrarian view, and I think it's worth taking. Specifically, if you do already have exposure to US tech and so forth, it's probably worthwhile to diversify a little bit.
Yeah, all right. Your take on Alibaba. Is it worth giving?
I concur.
Okay.
Yes, absolutely.
Yeah.
Look, I mean, these stocks are very cheap relative to their US peers, and frankly, this one and Tencent in particular have demonstrated, there are developments in terms of AI. They certainly have the capital and the expertise available to them. And if they get a fraction of the, call it, AI premium that's currently embedded in the likes of their peers in the US, there is significant upside from here. And just, I guess from a governance or maybe more a government perspective, the fact that the Chinese government is fearful of what US tariffs can do, the fact that they will have to be less reliant on the old export-driven model, trying to export themselves out of trouble as the economy slows down. Given that this trade war is going on, that's going to be more difficult for them. And they've seemed to have embraced the private companies this year. So from that perspective, we're hoping for a more accommodative Chinese government, a more robust Chinese consumer, and that just assists these Chinese tech companies significantly because their exposure is largely domestic.
Right. Well, gents, let us get to your stock picks for today. Alex, what are you hanging your hat on?
Yeah, so I'm going for AVI. I think it's a good opportunity to buy a quality South African business. I mean, the share price has been very weak since Q3, including year to date. And you're pretty much buying it at a dividend yield of about 7%. So I think very conservatively, if you assume they can grow earnings from 5% from this base, you're looking at a 12% type of return with upside risk to earnings, the actual rating of the stock P as well as special dividends. So all of a sudden, perhaps you can get, 15, 18% compounded return. I think that's very, very compelling for a relatively low risk stock. Yes, they got some headwinds in the short term. I mean, earnings might not really grow in the next 6 months or perhaps 18 months, but after that, I think AVI is looking quite attractive. So buy quality now. You don't really always get an opportunity to buy at these levels.
Right. What are you buying today, Cobus?
ABSA.
ABSA, yes.
I mean, in the local banking space, that one is incredibly cheap. I think, including the dividend, there's about 25%, 16%.
Hey, okay.
Capital growth or share price growth. In it, yes, the credit loss ratio improvement was well ahead of expectation. Cost control well ahead of what it was such that OPEX growth was lower than revenue growth, and we've had a recent in the previous H2.
Cobus, let's close it there. We've got it. We've got it. We've got the gist. Thank you so much for your time, gents. Really, really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, Alex Duys from Umthombo Wealth and Cobus Potgieter from Southern Cross Capital. Up next, The Close. Stay watching.